Howdy everybody, welcome back to another round of BFI. I'm Professor Martin. In our video right now we're going to be taking a look at analyzing a stock quote. And so really one goal in our video, learn how to read and interpret a stock quote. For example, if you haven't already guessed it, we're going to be taking a look at Nike. I'm a sneaker guy. I like to use examples that I'm familiar with. And so we're going to kick up the Nike stock quote. If there's a company that you would like to take a look at, drop me a line and let me know. I'd be happy to use an example that you find interesting in our future videos. So be sure to reach out to me. Let me know what you'd like to see. But for now, we're going to be taking a look at Nike. And we're going to pull up Yahoo Finance in order to find our stock quote for Nike. Yahoo Finance is a commonly used depository of stock information. You might also take a look at Google Finance. If you have a brokerage account, maybe you look up your stock quotes on your E-Trade or your Robinhood account. That's totally fine. All this information that I'm getting ready to show you would apply to any other stock quote that you might look at. But for our purposes, we're going finance.yahoo.com. And when you go to that website, you can see we have a couple of different boxes that we can enter our ticker symbol into. I've dropped NKE right here. That is our symbol for Nike. And when you click on Nike, it will bring up the Nike stock quote. Now, I gathered the information on the Nike stock quote on January 1, 2024. So if you're looking at the video a week later, you're probably going to find that the numbers are not going to be the exact same. Yahoo Finance and all the other stock quotes you're going to look at are going to be given in real time, meaning the numbers are going to change according to what's going on in the market. And so if you're looking at the video a year from now, Nike might be $120 a share, or it might be 90. Who knows? Nobody. But for now, on January 9th, 2024, here is the Nike stock quote. What we're going to do, y'all, we're going to go through and we're going to break it down kind of bit by bit here and kind of tell you what all the numbers right there mean. We'll start off right here at the top. You'll notice it says Nike, NKE, and then NYSE. That's the market that Nike is trading on, the New York Stock Exchange. You might find a stock quote where the stock trades on the NASDAQ market, the electronic market. A lot of our tech companies trade on the NASDAQ market. The NYSE is still a physical market where you have traders on a trading floor doing their deals. So you have the NYSE, you have the NASDAQ, and you may also see some of your stocks say OTC, which is an over-the-counter market, which is basically just kind of operative brokers dealing back and forth with one another. And that's for your stocks who maybe have been delisted. Stock price falls to a certain level and they get kicked off the NYSE or the NASDAQ. An example of that might be Jones's Soda. And you may have seen Jones's Soda at your Kroger in the specialty soda aisle. And they used to have a high-flying stock traded for $20, $30 a share, and now it trades for like 15 cents. So it trades on the over-the-counter market, not any of the bigger markets. And then you also have foreign markets. If you go back and take a look at that Nike stock quote, you'll notice it has a bunch of gobbledygook here. NKE.de, .mx, .ne. Those are all foreign markets. So when you see a dot followed by a couple of letters, when you're looking up a stock quote, that is telling you that the stock you're looking at is traded on the foreign market, the German market, the Mexican market, the Canadian market, the Japanese market. A lot of times American companies will kind of cross-list their securities so they're available in other countries. Same thing happens here. A foreign company may want to list their shares on the U.S. market, and so they'll cross-list them this direction. So if you're ever looking at a stock quote and you see the extra letters there, that's kind of what's going on. Of course, being an American investor, you'd want to look at the American listing. And it's usually the first one that pops up, so you don't have to worry about getting confused a whole lot on that. All right, so a little bit about the markets there. Let's move on down and look at that big bold number right there, 103.08. That is our current price per share based on whatever the last trade was. And again, that number is constantly changing as trades come in and out. The number next to it, you'll notice, is in red, negative 54, negative 52%. That is the dollar and percent change from the previous closing price, yesterday's close. Which if you look, our previous close was 103.62, meaning at the end of the last day of trading, Nike closed at 103.62. So based on yesterday, or the last day of trading, you can see we're down 54 cents or 0.52%. We're in the red. We've lost a little bit. Now, if we had gone up, these two numbers right here would probably be in the green. Moving along, we have a bid and an ask. The bid, the price at which someone will buy the stock. Someone has put on an order to buy the stock at 103.03, 1,000 shares. The ask is the price at which someone will sell the stock. Someone has put in a sell order for 103.04, 1,200 shares. And what happens when the bid price and ask price match up? That trade will happen. The difference between those two prices is called the bid-ask spread. All right, so we have a bid, we have an ask. We also have the ranges below. Obviously, the day's range are the low and high trades that have gone through for that particular day. The 52-week range are the low and high trades for the year. Nike has traded as low as $88 and as high as $131. Sometimes what people do when they're looking at stock quotes is they'll just kind of look at that 52-week range and say, oh, well, Nike's been as high as 131. Now it's 103. So if I just buy Nike at 103, it'll go back up to 131 in short time and I'll make a bunch of money. Obviously, it's not as easy as that. Just because Nike is traded at 131 this year doesn't mean that it's automatically going to go right back up to 131. There are reasons why the stock has gone from 131 back down to 103. Okay, so you got to be careful. You can't just look at that number and be like, oh, well, easy money, baby. Buy Nike and then smoke your victory cigar afterwards when it goes back up to 131. Doesn't quite work that way. Moving right along, we have volume. Volume is a measure of how many shares have been traded. So if you look at volume right here, at this point of the day at 10:19, on January 9th, 1.1 million shares have traded hands. Market opens at 9:30, so within less than an hour already, 1 million shares have already swapped hands back and forth. The average volume on any given day over the last 3 months is 9 million. So over the past 3 months, in any given day, about 9 million shares of Nike trade hands. So when we look at the end of the day, we may have heavy trading. If Nike comes in on this particular day and 12 million shares have traded hands, we would say that's heavy trading because 12 million is more than the average of 9. If we get to the end of the day and only 3 million shares of Nike have traded hands, we'd say, well, that's light trading because the average volume is 9 million. You see where I'm going with that? So we have heavy trading and light trading. If we're watching CNBC and they say Tesla was up $2 a share today on heavy trading. And heavy trading, that's what they're talking about, based on the average volume. All right. Yeah, take a look at that a little bit closer. I got the Boeing company. Same day, January 9th. You notice already at 10:30, the volume is over the average. 6.9 million shares traded hands compared to the average volume of 6.4 for the whole day. And so an hour in and we're already over the average volume. So Boeing is being heavily traded right here. Why is that? Usually what happens when we have a scenario where we have heavy trading, some kind of news has dropped that has caused people to want to buy or sell that stock. And so if you're in 2024 with me, if you're in January 2024, you might have seen in the news a news story that has happened. There was an Alaskan Airlines flight. Plane was taken off and literally the door just blew right off the side of the plane. Yikes. A nightmare scenario if you're up in the air and suddenly where there was a door, there is no longer a door. Boeing was the manufacturer of that plane, 737. And so when this happened, they grounded many other 737 Boeing planes. A PR nightmare if you are Boeing. And so the stock market reaction is to perhaps sell that stock. And as you can see, high volume, heavy trading, people are selling off their Boeing stock out of fears that maybe this is a big problem from a manufacturing standpoint at Boeing. So that's heavy trading. Back to Nike land here. We're into the second column of data. We have a market cap. Market cap is a very important number. Market cap is the market value of the entire company. Cap being short for capitalization. Market capitalization, market cap. If you were to take and buy every share of the company that's outstanding, that's the market cap. How much would it take to buy the whole shebang? It takes about $150 to buy a pair of Nike sneakers. It's going to take about $155 billion to buy the entire company. Market cap, share price, times the number of shares outstanding. If you're going to buy the whole shebang, it would take $155 billion. Now, when you're thinking about, as an investor, how much is a company worth? A lot of times we fixate on that per share amount because that's the amount that we're paying to buy into the company. I have to pay $103 to buy one share of Nike. So that's the kind of the number that we fixate on. That's what it's worth. But really what it's worth is that market cap. All right? That per share price is simply a function of how many shares are out there. Really, Nike's worth $155 billion. So when you buy Nike stock, what you're thinking is, okay, I think that Nike is going to be worth more than $155 billion in the future. And that's the gamble or bet that you're making there. Next up is beta. You can see beta 1.12. Beta is a measure of how volatile the stock price is compared to the market as a whole. If you have a beta of 1, you're basically saying that the company is as volatile as the market as a whole. If you have a beta of less than 1, you're saying the company is less volatile. The stock price is less volatile than the market as a whole. Oop, went too far. If your beta is more than 1 or greater than 1, you're saying the stock is more volatile as the market as a whole. And so if we look at Nike, a beta of 1.12, we're saying that Nike is roughly 12% more volatile than the overall market. Not a whole lot more volatile, about as volatile as the market as a whole, but just a little bit more. Okay? You may have played the stock market game before, maybe in an economics class, and your goal in that stock market game is to make as much money in as short of time as possible. You know, you only got like 6 weeks, 8 weeks, 12 weeks, whatever the case might be. When you're playing the stock market game, you don't want stocks with a beta of 1 or 1.12 because they're going to move pretty much exactly like the market moves. You want a stock with a beta of like 2.5. It's going to be twice as volatile as the market. So when the market goes up, you know, maybe 2%, that stock might go up 5%. It's volatile. Opposite would be a company like Coke. Look at the beta for Coke, 0.58. Not very volatile at all. Pretty consistent cash cow company. That 0.58 indicates that Coke is roughly 58% as volatile as the overall market, or about half as volatile as the overall market. You can also put it a different way. It's 42% less volatile than the overall market. All right, so a low beta company would be a company with a beta of less than 1, meaning it's not quite as volatile as the market overall. Next up, we have our friend, the PE ratio. We don't have to dress out to calculate the PE ratio. You remember dressing out in high school for PE? Nah. The PE ratio is our price earnings ratio. And we're stating it for TTM, the trailing 12 months, or the past year. So PE ratio of 29.98. The way we get that number is simply just like our ratio suggests. We take the price of our stock, we divide it by the earnings per share. These numbers are updating in real time, so the math doesn't exactly perfectly match up. You can see we get 29.98. If we do the math, we really get 30. Maybe a penny or two off there, but that's the idea. The price divided by the earnings per share. So who cares? What does that number tell us? Well, that number tells us we're paying $29.98 in stock price for every dollar of profit Nike has earned. It's a measurement of how expensive the stock is to buy. The higher the PE, the more we're paying for those earnings, the higher the stock price is perceived, or the PE is perceived to be. The more expensive the stock is perceived to be. The higher the PE, the more expensive the stock. Traditionally, stocks will trade 15, 20, 25, in that range of price to earnings. If we start getting well beyond 25, like 50 PE, 75 PE, 100 PE, the stock may be considered to be overvalued. If we have PEs of like 5 or 10, stock might be considered to be undervalued. Just depends. So that's our price to earnings ratio. We also have earnings per share. That is a measurement of the amount of profit that the company has earned per share. In Nike's case, $3.43, they've earned $3.43 in profits for every share that they have outstanding. Very important number. Investors always want to see that EPS growing, getting higher and higher and higher. And so we look at EPS quite frequently, earnings per share. Calculation can be a little bit tricky. We talk about it in intermediate accounting, the different ways that we can calculate earnings per share. We have a basic and a diluted earnings per share calculation. All we really need to understand here is that we take earnings and divide it by the number of shares outstanding. All right, moving right along, we have an earnings date, when the company is expected to put out their quarterly earnings report. So you can see how much profit or loss they had during the quarter. For Nike, we also have a dividend and yield. The dividend is the company distributing profits back to the shareholders, the amount per share that every shareholder will receive. So in Nike's case, for every share that you own in Nike, you'll get $1.48 in a dividend. The yield is simply that dividend divided by the share price, the percentage return that we're getting via dividends based on current share price levels. So if I bought a share of Nike at 103 and I got my $1.48 dividend, I would be earning 1.43% on that $103 investment from that dividend. So you get the dividend and you sit around and wait for stock price to go up. Best of both worlds. You get paid to wait with that dividend. Ex-dividend date is another kind of important dividend marker there. That is the date that you no longer get that dividend. And so if you own Nike stock on November 30th or before, you'll get that quarter's dividend. If you buy it December 1st, you do not get the dividend for that quarter. That's why it's called the ex-dividend date, without dividend. You're without dividends as of December 1st if you are a Nike stockholder. If you owned it the day before, you would get that quarter's dividends. So they have to cut off at some point when they're making those quarterly dividend payments or annual, and they actually check the records to see who's a stockholder as of a certain date. And so whoever is owning Nike stock as of November 30th gets the dividend for that quarter. If you buy into it December 1, you are ex-dividend, without dividend. And finally, we have the 1-year target estimate. That is an analyst prediction as to what the stock will trade for in a year. It is not a guarantee. You see it all the time. Stocks don't reach a level that they're predicted to get to. All right, so you can kind of take 1-year target estimate with a grain of salt. It's just an estimate. It's a guess. It is no means a guarantee. Just a sentiment as to what that stock might achieve in 1 year or where it might be. So, a couple things to wrap up here. I mentioned that all of these quotes are dealing in real-time information. I originally pulled the quote at 10:19 a.m. You can see it's 103. Within an hour, it's already gone down another 34 cents right there. You can see our PE ratios changed a little bit as a result. And so that's just going to happen. Constantly updating to reflect the new market prices. So just be aware of that. Talked about Jones and Soda a little bit earlier. Brought up their stock quote here. You can see 14 cents a share trading on the OTC over-the-counter market. You'll notice Jones & Soda does not have a PE ratio. The reason for that is Jones's Soda does not earn a profit. They are losing money. So if you have a company with a negative earnings per share, you can't calculate PE because we can't divide by a negative number. So PE ratio says NA. That means that we can't calculate it. They are losing money. They have no profits. Okay? Down here, you'll also notice that the dividend is NA. That simply means the company does not pay a dividend. Obviously, if you're losing money, you're probably not going to pay a dividend, but there are profitable companies who don't pay a dividend either. Like maybe a Tesla comes to mind. The reason for that is they're taking all those profits and plowing them back into the company. And so if you see NA, that just means the company's not paying a dividend. So be on the lookout for that as well. That's it, y'all. How to read a stock quote. I encourage you to jump on Yahoo Finance, pick a company that you're interested in, maybe Walmart, Netflix, Snapchat, whatever it might be. Take a look at their stock quotes. See if you can understand everything you're looking at. If you have any questions at what you're looking at, I'd be happy to help. You can reach out to me anytime. Send me a ticker symbol. Hey, also, like I mentioned at the beginning, send me a company that you'd like to use as an example. I'd be happy to pull in an example from the crowd here, and we can talk about things that are of interest to you as opposed to my sneaker collection. Until next time, take care, everybody.